to Avalara's state-specific webinar on California. My name is Scott Peterson. I do government relations for Avalara, but government relations is just one of like 45 things I do for the company. There's my picture. My experience, and one of the reasons why I'm with Avalara today is that Avalara, like all of you, spends an inordinate amount of its time dealing with state taxes. We spend all our time dealing with state taxes, and my experience is that's of real value to Avalara is 10 years as director of the South Dakota Sales Tax Division, which was one of the completely unlike the California sales tax system that we're going to talk about today. And I will give you some comparisons as we go through the presentation today on how broad the concept of sales tax is in this country and how California fits in frankly on one end of the spectrum on how the sales taxes are administered and how the sales taxes are implemented. So what we're going to talk about today, we're going to talk about what do you do to get started. You're a new business, what do I have to do? Or you're an existing business in Wyoming and you're going to open up a branch in California. What do I do? What is California tax and exempt? Things you need to do, things you need to know. Rates and other factors about calculation. What is it about their rates that you need to understand so that you can get it right the first time? Local taxes, and you see the word district in there because one of the things that makes California unique is in this concept of a district. When I think of a district, I think of special taxing districts, and in California they can be a special taxing district, but the word district is also the word that they use for all local taxes. And if you look at their publications and all the things that they use to help educate taxpayers, they use the word district rather broadly, and they might be talking about the town of whatever or the city of Los Angeles. Or they could be talking about the Bay Area Rapid Transit District. Talk a little bit about filing returns and making payments, and then some of the other taxes that a normal retailer might find themselves facing. Okay, they will call you a seller. Under state law, you are a seller. They have a somewhat unique organizational structure. They have an elected tax commission. There are others. There are other elected tax collectors. North Dakota has a tax commissioner that's elected. Maryland and Texas have a comptroller who is elected, and taxes fall under the comptroller. But in California, they have a thing called the State Board of Equalization, and the State Board of Equalization is where their sales tax rests. It's also where property taxes are, and it's made up of 4 commissioners who are elected from districts. The state of California is divided up into 4 districts, and each district is represented by 1 commissioner on the Board of Equalization, and then the 5th person on the Board of Equalization is their statewide elected controller. That person you might consider them to be the treasurer of the state. In most other states, they would call that person the treasurer. That 5-person commission employs the executive director of the Board of Equalization. The Board of Equalization, the executive director then is the person responsible for everything else that goes on inside the Board of Equalization. So that person hires and fires all of the people that work there, and it is a huge agency. One thing that makes California different, in addition to having an elected state tax commission, is that they're not the only tax agency inside of California. There is also a thing called the Franchise Tax Board. And the Franchise Tax Board is where their income tax is administered. So if you're a business person in California and you have employees, you are going to get to interact with both the Franchise Tax Board and the Board of Equalization. And you need to keep in mind that they have entirely different functions, entirely different. The Franchise Tax Board is not elected, and they're just run differently, report to different types of people, and you shouldn't be surprised if one treats you much differently than the other because they are much different from each other. So you must have a seller's permit if you are engaged in business in California, and we'll talk about what that phrase engaged in business means. If you intend to sell or lease tangible personal property that would ordinarily be subject to sales tax, and that's a phrase they like to use, that would ordinarily be subject to sales tax. There is while they have 1,000 different publications and manuals, truly 1,000 on their website explaining things, they use that phrase would ordinarily be subject to sales tax rather frequently, like you should know. Or you will make sales for a temporary period, normally last not longer than 90 days. Oh, Christmas trees, garage sales, which aren't taxed much anywhere, unless you're running a continuous garage sale. And if you are, you probably have more problems with your local city than you do with the Board of Equalization. Fireworks, those things that are temporary, Christmas, 4th of July. You must have a permit for each location. You can't have 25 stores in California and have one license for the 25 stores. You have to have 25 licenses for one each for the stores. And you might also, and very likely, need a local business license. It is getting to become quite common around the country that local governments will want a license. A as a way of generating revenue, and B as a way of making sure that they know who is in and who is not inside their city. So, engaged in business. Remember, you have to have a seller's permit if you're engaged in business in California. To be engaged in business in California means you have an office, a sales room, a warehouse, or other place of business, even if it is only temporary. So you have a pop-up store that you're running in San Francisco for the month of October to try to test out whether or not you have a viable business model in California. Well, even though it's temporary, you're engaged in business. Having sales representatives, agents, or canvassers operating in the state. If you have your employees there that are making sales in the state, or you have independent contractors that are in the state on your behalf, you've created a market for you, you're engaged in business. Or you receive rental payments from the lease of tangible personal property in the state. And obviously, the rental payments themselves isn't the issue. It's the leased property in the state that's the issue. Leased property is if you have property in California that you're leasing to someone in California, you have physical property in California. You have nexus with California. You're the one that that owes the tax, and not the person who is leasing from you. So, one of the things that is unique about California is the extraordinary list of things that you're going to have to provide to them to get a permit. Social Security number, which is a relatively common thing. Most states want an FEIN. If you don't have an FEIN, then they're going to want your Social Security number. That's standard. Every state in the country makes that a requirement of a person that's opening a business in their state. It's fairly common around the country, though, that the corporate officers will have to provide a Social Security number. So if you had even in states where you have to provide an FEIN, and the business doesn't have a Social Security number, it's fairly common for the corporate officers to have to provide their Social Security number. It's, in my personal opinion, completely unnecessary, but it's still a requirement. Driver's license number or some other form of ID. And when they say they want your driver's license number, they want to see your driver's license. They want a copy of your driver's license. They want to actually hold it in their little hands. Makes it very difficult to license folks from afar in California because of that requirement that they want to see your driver's license. Name and location of a bank account. That's, if there are other states that make that a requirement to get a permit, I don't know that. I've never read that anywhere. Names and addresses of suppliers. That's becoming more common around the country, and it's relatively common if you're going to sell tobacco or you're going to sell alcohol. Bank account. Once again, another unusual thing for someone to have to provide. Anticipated average monthly sales and the amount of sales which are taxable. That's relatively common. It is people, departments of revenues, board of equalizations, whatever they're called, they need to put you into boxes. And one of the boxes that they put you in is driven by what they think you're going to do in sales. And that is, how often do you have to file a return? They don't know whether to make you a monthly filer, a quarterly filer, or a semi-annual filer unless they know how much you're going to collect and remit in sales tax. So even though it might just be a guess on your part, they're going to make you make a guess. And then email address, because every Department of Revenue is moving away from traditional mail, just like every retailer, every wholesaler, everybody is, and they're all going to email as a way of contacting you. Remember, you need to provide that information for every place that you have a location in California, because you need a separate permit for each one. Okay, now we're going to talk a little bit about their sales tax. I don't know of another state that uses the word reimbursement in their official publications as the term to describe you charging sales tax to your customers. I honestly don't know of another state that uses the word reimbursement. There are two types of states in this country when it comes to sales tax. There's a vendor state and a vendee state. A vendor state is a state where the sales tax is legally imposed upon the seller. And you'll see these statutes. In a vendor state, you'll see a statute that says, for the right to engage in business in state X, there is a legal obligation to collect sales tax. And you go through the administrative, the collection process, the collection statutes and the administrative statutes, and all of them will refer to the seller as the taxpayer and not the consumer. And in a vendor state, they don't care if you collect that money from your customer or not. California is maybe the extreme, well, maybe not quite the extreme, but pretty close to the extreme on that concept. And I'll show you why here in a second. The tax falls on the retailer. Retailer can get a reimbursement for that tax from their customer. The other type of a state is a vendee state. In a vendee state, the tax is legally imposed on the buyer. So you see those statutes. There is hereby imposed a tax of 4% upon the purchase of whatever is taxable. And then the next statute will say there is a legal requirement on every seller in this state to collect the sales tax from their customers. So remember, two types of taxes, vendor, vendee. Vendor, the tax is imposed upon the seller, the legal incidence of the tax, not the economic incidence. That's, you know, your ability to pass on to your customers, but the legal incidence of the tax falls on you, the seller. In a vendee state, the legal incidence of the tax falls on the buyer. It's not your tax, it's their tax, but you have a legal obligation to collect it from them. As I said, the differences in the end are relatively insignificant, because whether the tax is imposed upon you as the seller and you can get a reimbursement from your customers for that tax, or whether or not the tax is on your customers and you're legally required to collect the tax, at the end there is very little that a seller wants to pay out of their own pocket. And so every seller is going to try to collect this tax from their customers if they can. And so at the end, you get to the same spot if you're doing a good job administering their law, because at the end you're going to collect the tax from your customer and you're going to call it good. So, like I said, California is a vendor state. The tax legally falls on the seller regardless of whether or not that seller passes the tax on to the buyer. They go to great lengths to explain to you how you can get a reimbursement. In most states, in most vendor states, there's a sentence somewhere in a statute that says it may be passed on to the consumer or may be passed on to the buyer, and that's it. That's all there is. Not California. California, a seller may be reimbursed by the buyer for the amount of the tax the seller owes. Interesting. I mean, think about how they use their words. Tax the seller owes. It's your tax. You are legally required. If the tax is listed as a separate amount for sales tax reimbursement on receipts or invoices, the seller posts a sign stating that a sales tax reimbursement will add at all prices of taxable merchandise. Walk into a store, sign says all prices are exclusive of tax. Makes a similar statement on price tags, advertising material, or other printed material directed to the purchaser, or the sales agreement specifically calls for the addition of sales tax reimbursement. So if you're doing business in California, state expects you to pay the tax, and they give you ways of getting a reimbursement from your customers for that tax. But like I said, I'm not aware of another state that uses this concept of reimbursement to the degree that California does. Okay, so what does California tax? I would say that they're a traditional or a typical state. All tangible personal property is taxed unless specifically exempt. That's the norm around the country. Every state in this country that has a sales tax has a statute that imposes that tax on all sales of tangible personal property unless specifically exempted. Every state in the country that sales tax has that statute. Most states, actually all but four or five, is it 4 or 5? I think it's 4, have another statute that says that all services are exempt unless specifically taxed. Now sometimes this all services exempt is unstated. It's inherent in the way they tax, and you'll see this actually in several states where you see a statute that imposes sales tax on all tangible personal property. No mention of services in that statute whatsoever. Then they'll have another statute that says, in addition to the tax imposed upon tangible personal property and yada, 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 we hereby impose tax on the sale of dry cleaning services and laundry services and haircuts and things like that. That's really probably more of a typical state. Like I said, there are the states that have this presumption on services that's like the presumption on tangible personal property. All that would be Hawaii, New Mexico, South Dakota, and West Virginia. In those 4 states, they tax all services unless the services are exempt. So if you're doing business in California and that's your only experience, and you open up a business in Hawaii or New Mexico, you need to learn the differences between those 2 states and California, because one area where California is seriously different than everybody else is they tax very, very few services. Probably, if not at the bottom, extraordinarily close to the bottom in the number of services that are taxed. A typical state will tax 25 services. California is into the less than 10. Very, very, I wouldn't say unusual, but frankly it is a little bit unusual. Obviously, South Dakota and New Mexico, they tax, several hundred services, or frankly every service, regardless of, it could be thousands. California is just the opposite. If you your services are subject to tax in California, because there will be a law that applies exactly to you. And you'll see it and you'll think, ah, okay, I am that, so I know. So if you're in the tuxedo rental business in California, you're subject to their sales tax. And if you're renting shoes, have nothing to do with tuxedo, you're not subject to sales tax. Tire recapping and repairing, personal property rentals, service contracts for tangible personal property sold at the time of the sale of the tangible personal property. So if you buy a brand new clock radio, and that sales person convinces you to buy the 2-year extended warranty on that clock radio. If you buy that warranty at the time of sale, you're going to pay sales tax on that warranty. Most leases are not services. Most leases under California law are treated as a continuing sale or continuing purchase. And so every month is a sale in California's eyes when you are leasing a product. For most products and under most situations, their local tax applies on the sale, but it's going to often be the use tax, because if you are a Los Angeles-based lessor of whatever, and your products are all over California, you're going to be collecting the local use tax in those jurisdictions where you don't have a location. Okay, what more about California? Oh, I included this one because when I was with South Dakota, I went through this particular thing, and we had to make a decision. We in South Dakota went the opposite way that California has gone on this. But if you're in the business of selling cell phones in California, sales tax applies to the sale of a cell phone depending on whether it is a bundled or an unbundled transaction. And there's a few other states that do this, but not the majority of states don't do this. An unbundled transaction is when a cell phone is sold without a service plan. You go in, your phone breaks, you've got a service plan, and you go to Walmart or Best Buy and you buy a phone. You don't get a service plan, you already got a service plan, you just need a new phone. Or a bundled transaction is when a cell phone is sold with a service plan. So instead of going to Best Buy to buy your phone, you go to Verizon to buy your phone, and you get a phone with a 2-year service plan. If it is an unbundled transaction, you've gone to Best Buy and you're just buying a cell phone, but no, you already have a service, then cell phone is based on the sales price of the phone. Excuse me, the taxes. Tax is based on the sales price of the phone. In an unbundled, no, so in a bundle transaction, you're buying a phone plus a service, California knows that, or at least historically, that industry has deeply discounted the price of the phone if you are willing to do a multi-year service contract. And everybody knows, I mean, everybody knows you're getting that somehow, some way, that value of that phone is being priced in your service contract, and you really are paying for it, even though you may not pay full price for that cell phone. You're paying for it some way or another. In California, if it's a bundle transaction, you, the retailer, have to know the definition of an unbundled sales price, which is either the sales price typically charged for the specific cell phone when sold without also requiring the purchase of a service contract, or the fair retail selling price, which is the cost of the phone plus 18% markup. It's, like I said, when I included this in here because I went through this one in South Dakota, and that was back in the days when you could buy if you got it for a 2-year service plan, you could get a cell phone for a penny. And the departments of revenues around the country were going crazy because no one believed they were selling that phone for a penny. But in California, most states have gotten over it and said sales tax applies whatever you pay for your service plan, and that's it. California hasn't gotten over it yet. Okay, So let's talk about what they exempt. They actually exempt a lot. And one of the, frankly, many of the things that they exempt are commonly exempted around the country. So it wouldn't be fair to say that, you know, that they have a tax structure that's not as reliant on the sales tax as other states, because every state in the country exempts prescription medicine. Almost every state in the country exempts prosthetic devices and orthotic devices. California uses some interesting terms and phrases when they exempt medical devices and equipment, but they pretty much get to the same spot as every other state, in that which is if it's prescribed by a doctor, it's exempt. Agricultural inputs and equipment, another normally exempted piece of area. Most states exempt agricultural inputs. Actually, almost every state exempts agricultural inputs, and most states exempt agricultural equipment. In one exception, one thing that makes California a little different is this is a state exemption and not a local exemption. So agricultural equipment are subject to the local taxes in California. So if you are a retailer of agricultural equipment, you know that you don't charge the state sales tax, you charge the local tax, and it could be complicated because you may be delivering this stuff outside of the boundaries of a local taxing jurisdiction. Manufacturing and research and development equipment are exempt from a portion of the state sales tax. Not all of it, but they're exempt from 4.1875% of the state tax. So they use a relatively, I would say standard, because there is no such thing as a standard definition of a manufacturing equipment exemption. But it's pretty, I mean, it's pretty typical to what you see in other states. I mean, if it's used in the manufacturing, if it's equipment and it's used in the manufacturing process, it's exempt. In most states, it's exempt. In California, it's mostly exempt. Gas, electricity, water, and steam, when delivered in main lines and used for residential purposes, is exempt. The main lines is I wouldn't say it's unique, because there are other states that presume, there are states that use the word pipe. So gas, electricity, water, and steam piped into a home is exempt. And of course, every one of those states has another exception for propane. You know, so they've got this main line or that pipeline exemption for all these products, and then they also have to have another exemption for propane because that's not delivered in the main line. And it's for residential purposes. Food for human consumption, which is probably a better definition than in a lot of states. If you're in the grocery business around the country, you know that there are 15 different definitions of groceries, and it's sometimes a little peculiar how they come up with these definitions. There's a presumption in many states that the retailer has to make about where you're going to use the food sold for off-premises consumption, which is several states in the country have an exemption for food sold for off-premises consumption. Well, how in the heck does that retailer know what that person's going to do with it? But so California's food for human consumption is exempt unless sold in a heated condition, relatively normal around the country, served as meals. Heated condition, served as meals are a proxy for prepared food, consumed at or on the seller's facilities. So you buy a baseball at or you buy peanuts, not baseball. You buy peanuts at a San Francisco Giants game. That's food for human consumption. Purchase in a bag. If you bought it in a grocery store, it'd be exempt. But since you're consumed it at or on the seller's facility, and which is what they make the presumption, they're presumed if you buy those peanuts at the baseball stadium, you're going to consume them at the baseball stadium. So they are they're not exempt. Ordinarily sold for consumption on or near the seller's parking facility, so you have a food truck outside. That would be the hot dog stand outside the Home Depot, or foods sold for consumption where there's an admission charge. So you go in and you buy things that you could buy at a grocery store that would be exempt, but because you paid $25 to get in, it then becomes taxable. Okay, what else? They exempt most nonprofit organizations, and they also exempt the sales from most nonprofit organizations. So if you're in the nonprofit business and you're selling, and your organization sells things as a way of raising money for your organization, those sales are rarely going to be taxed in California. But you are the user and consumer of the material that you use to sell. So if you're selling hot dogs to raise money for the local PTA, you're going to pay sales, well, that's a bad example. Hot dogs are going to be exempt when you buy them. Let me think about that. The American Legion, when they sell their poppies, the little paper poppies that they do, the sale of that would be exempt, but when they bought those, they would pay tax on them. This concept of a user and consumer being liable for the tax on the things that they use applies to services, which is a pretty normal thing around this country. Almost every state, and if there isn't a state that does this, I'd be surprised if there is a state that doesn't do this. If you're a veterinarian, your service as a veterinarian is exempt from sales tax, but most, if not all, the things that you use in your veterinary practice are taxable to you as the veterinarian, and that goes so far as to include some of the drugs that you use on the animals that you're treating. So any kind of a service, frankly, in California, and I've only listed a couple here, but any one of them is going to be exempt for the most part, but you as the service provider are going to owe tax on all the things that you buy to operate your service. The state also exempts installation labor, transportation charges, and that's in services in general. They just exempt services. But these things need to be, if you're selling these along with tangible personal property, you need to separately state these on invoices. Like most states that exempt these things, if you don't tell them that you're selling something that's exempt, the state has no choice but to presume that whatever's on that invoice is part of the tangible personal property and should be taxable. So always separately state installation, transportation, so that there isn't any confusion when your customer gets audited by the state, or they come in and look at they audit you and they look at your invoices and find that you've sold, a TV, and you failed to include the installation charges for that TV. So if you don't separately state the installation charge, you install the TV in the person's billiard room. If you don't separately state the installation charge, they're going to assume, the state has no choice but to assume that the entire charge was the sale of the TV and expect sales tax on that. Shipping charges are generally exempt from tax, provided for delivery directly to the purchaser by common carrier, contract carrier, or U.S. mail. The invoice clearly lists delivery, shipping, freight, or postage as a separate charge, and the charge is not higher than the actual cost for delivery. Now that last one is, I was actually a little bit surprised to see that, because in most states that exempt shipping charges, they don't care what, there are states who believe that last sentence actually is in their law, because the states that all exempt shipping are convinced that you're selling a $5,000 TV, but you're really selling it for $3.75, and you're charging the difference in shipping. And they separately list the $4,996.50 as shipping and handling, and you're only collecting sales tax on $3.50. Every state tax administrator believes that somebody's out there doing that. That's why it's really important that if you are charging shipping and handling, that you know what the rules are in your state, and then if you're in California, you know that it can't be higher than your actual cost. So if the post office charges you $25, you can charge $25. If you don't, then what you're really doing is padding the price of the product, and that's how the state will view that. So what else is they exempt? Everything that's digital. This is, I wouldn't say that they're lagging the rest of the country, but they're pretty close to lagging the rest of the country on this issue. Most other states have taken the position, either statutorily or administratively, that a number of these things are taxable in their state. Most states, the ones that are doing it right, are doing it, statutorily, so there is no confusion. But electronic data products such as software, data, digital books, mobile applications, and digital images when transmitted over the internet or by modem are exempt from sales tax in California. The exception is if the customer gets a printed copy or something electronic. Remember this, California is a state that taxes tangible personal property. And they have a statute that defines tangible personal property as those things that can be touched, feel, sensed. And it's the Board of Equalization's position that things delivered electronically aren't tangible. And as such, the only time it is ever taxed is when the customer gets something that is tangible. So if you're selling software to a customer canned software to a customer in California, and you send them a disk with a backup copy on it, you've just turned an exempt electronic transaction into a taxable, tangible transaction. The addition of that CD, a backup copy of that software, turns that transaction from an exempt transaction into a taxable transaction. So how do they administer their exemptions? They, like most states, not every state, but well, like half the states, put it this way, like half the states, liability falls completely on the seller. So you, the seller, are completely financially, legally liable for determining the validity of your customer's exemption. You have a customer that comes in and says, hey, I'm the Boy Scouts of San Diego, and it's really not the Boy Scouts, and you fall for this scam. The state of California doesn't care that you were scammed. They will expect that tax from you. And when they audit you, they'll expect you to show proof that that was the Boy Scouts of San Diego. And if they can prove that that wasn't the Boy Scouts of San Diego, you're going to owe the tax. You must maintain copies of certificates of exemptions, documents that support shipment of merchandise out of state locations. Actually, California has 45 different exemption certificates, exemption declarations, and exemption affidavits. Any one or multiple ones that you may have to keep in your books and records. And the good news is they're all out online, and they're all online fill-inable forms. But you, the seller, are liable for the maintaining that document. I was looking at one this morning for another project I'm working on. They exempt, they provide a 60% exemption for the sales of manufactured homes. And the 60% exemption is a presumption that 40% of the house of the purchase, 40% of the value of a manufactured house is materials, and 60% is labor. So they exempt labor, and so they give you this exemption. There is an affidavit that you, the buyer, have to complete and give to the seller, and the seller has to keep in their books and records that affirms that you understand that there was a 60% exemption. You, the seller, are obligated to maintain all these. You, the seller, are required and will be legally held liable and certainly not criminally or civilly, but financially, if you aren't maintaining these exemption certificates the way the state wants them to. So another exemption administration thing that used to be the norm around the country, and I hate to use, I apologize for using the norm because I don't like to use the word normal because I don't think normal exists, but there was a time in this country when the majority of states had this rule in place, the rule on drop shipments. A drop shipment is the delivery, and just so everybody's level set here, a drop shipment is the delivery of tangible personal property by a California seller on behalf of an out-of-state seller to a consumer in California. Now, in this case here, the California seller may not be a retailer, may be a wholesaler, may be a manufacturer. In a normal drop shipment transaction involves two businesses, two sales, and one consumer. The true seller is the out-of-state business that isn't registered, but who sells the product to a consumer. New York City-based seller of children's beds. They have a customer in California. New York retailer makes a sale to the California customer for this children's bed. They don't have an inventory of children's beds. They have a wholesaler that drop ships them, and just so happens this wholesaler is located in California. So this California-based wholesaler drop ships, delivers, makes a sale to the seller. So this is the second, two businesses, wholesaler, seller, two sales. Seller makes a sale to the consumer. Wholesaler makes a sale to the seller. And the wholesaler ships the product directly to the consumer in California on behalf of the true seller. So what the majority of states used to do, only a handful still do today, is that the California business, the one who is registered, even though they're not the real seller, is liable for the tax. So you're a California wholesaler, or you're a wholesaler who has a location in California. You're registered to do business in California, and you sell your product to a retailer / seller in another state who wants you to deliver that to their customer in California. You need to find out whether or not that your buyer, the other seller, is registered in California, because if they aren't, California expects you to collect sales tax, and they expect you to collect sales tax from the seller. Okay, tax rates and how to calculate the tax. State tax rate is 6 1/4, but that isn't exactly all it is. They have a thing called, there's a basic statewide sales and use tax rate is 7.5%. So the state rate is 6 1/4, but the basic statewide sales and use tax rate is 7.5%. And that's comprised of the 6 1/4 state tax, a 1% local jurisdiction, which is city or county of place of sale or use, and then a 1/4% local transportation fund, which is also the county, that in this case is the county of the place of sale or use. And this all comes from a thing called the Bradley-Burns Uniform Sales and Use Tax, which was a law that was adopted by the people at a vote. In addition to that, in addition to the basic statewide sales and use tax, they have these things called district taxes, which are imposed locally under the transactions and use tax law. And now it says transactions and use tax. So everywhere in California publications you see the word transactions, you'll always see the word sales in parentheses behind it. So they call it a transactions tax, but it's really their local sales tax. And the tax rate in an area may be higher than 7.5%, depending on the district tax that apply there. And they are as high as 10%. And there are hundreds of these. They're everywhere in California. And to make things worse, there's spots where there aren't any. So I'm going to quickly go through this transaction tax versus use tax thing. The use district to refer to any local unit of government, including a city, county, town, or special district. There are hundreds of districts with a tax, and there are lots of places that are subject only to state tax. So, and you know California. California is an immense geographic state with a huge population, and yet it has an unbelievable amount of that state is unpopulated. Well, is not inside of a city or inside of a city or a special district. So there's all kinds of areas in California that are in a county and in a state, therefore would be subject to the basic statewide rate, but would not be subject to any district rate, any other rates, because there are no other districts. There is just the state basic statewide rate. Two types of taxes: the transaction, see the word sales in parentheses, imposed on the sale of tangible personal property in a district, and then use taxes imposed on the storage, use, or other consumption of tangible personal property in a district. So you, the seller, could be obligated for collecting both of them, or either of them, not both at the same time. A retailer is responsible for reporting and paying the transaction tax if located in a district. So you're in a district, that district has a transaction tax, you are required to collect that tax. If you have more than one business location, the liability for district tax will depend on the location where the principal negotiations for sales are conducted. And if you, in this concept of principal negotiations applies to transactions where you have somebody that takes an order and the order is processed in another location. You know, the actual sale occurs somewhere else. If you have a jewelry store in Pasadena and a jewelry store in San Diego, the principal negotiation of those sales are conducted right there at those individual store sales. Let's see. A seller whose only business location is in the district must generally report transactions tax on all sales, unless the seller, the seller's agent, or a common carrier ships or delivers a property outside of the state or outside of the district, or obviously if the sale is exempt from the sales tax, the state sales tax. Sales of property made in a district and delivered to a consumer outside the district may not be subject to that district's tax, and the words may not are in there for a reason. They may be, depending on what you do in that other district. So you have a location in a district. There's a thing called being engaged in business in a district that is similar to the definition of engaged in business for the state, but they're not. They don't apply the same way. You may be expected to collect the tax if you were engaged, like I said, if you're engaged in business in the district, even though you are located outside the district. And then in that case, you're very likely going to be collecting that other district's use tax. So if you're an out-of-state seller who for some reason needs to collect California's tax, you're going to collect their California use tax. And the same thing inside the state. If you are in a district in your location in Los Angeles and you're making a sale into San Diego and you're doing that with your own vehicles, you're engaged in a business in San Diego, and they're going to expect you to collect the San Diego use tax. And this is important because Nexus is, location specific for local taxes. You don't necessarily have Nexus all over the state if you are in California. This is like Colorado, and this is like Texas. This is what's called origin sourcing for local taxes, and it's in California, it's in Colorado, it's in Louisiana, it's in Texas. Where you are, if you're in a state, doesn't necessarily mean you're everywhere in a state for local tax purposes. Okay, so if you're engaged in business in a district, as I said, it's a very similar definition to the state's definition. You lease, store, or consume tangible personal property in a district. Very similar. So here's the deal. So you're engaged in, you may be responsible for collecting the district's use tax if you're not located. If your store is not located in a district, you may be responsible for collecting another district's use tax if you're engaged in business or you lease, store, or consume tangible personal property in that district. And this is the definition of engaged in business, very similar to the state's definition. So even though you don't have a store location if you're a Los Angeles retailer and you make sales in San Diego and you don't have a store location in San Diego, if you meet any of these terms for being engaged in business in San Diego, you will be required to collect the San Diego use tax. Same thing with a lessor. So I remember that leased property is taxable in California, and leased property is taxable in local governments in California, and the tax follows the lease payment. So if the leased property moves, the tax moves. And it's, I mean, just imagine you've rented a bulldozer to a construction company, and they have a project in Los Angeles this month, they have a project in San Francisco next month, and they have a project in San Diego the next month, and you charge them a monthly lease payment for that bulldozer. You will need to know where your bulldozer is, and you probably do because it's a $250,000 piece of equipment, and you will need to charge that construction company a different local district use tax because that district tax follows the product around. So if the construction company takes that product, if they're in the 4th month they have a project in Reno, Nevada, then it's going to be a function of, it won't be subject to any California tax, but you may be subject to Reno taxes. Once again, if that construction company has a project outside of a district, you know, they've got a project out in the rural area of California where there isn't a district tax, it's always going to be subject to the statewide basic rate. Don't forget that. That statewide basic rate applies statewide. Then you can, and it didn't go into it, but there's all kinds of credits that are available if you first use it in a jurisdiction that has a higher rate than where it's next used at, and those are all things that are important to know if you are a lessor, but I didn't have time to go over them in this presentation. So this is something I put in here, and it really means nothing to understanding how to collect California sales tax, but it tells you what degree the state is a little bit obsessive compulsive with their sales tax. These are all according to state law. So the state rate is divided into 1, 2, 3, 4 different things and 5 different things, and it all goes to different things by state law. Okay, so I'm about to wrap up here. Filing return and making a payment. Avalara is in the sales tax automation business, and we have lots of employees, and we want them to understand state and local sales taxes. So when we do our training of new employees, we train them on the California sales tax return, because in our opinion, it is the most complicated sales tax return in the country. And it is because, not because they have, you know, 1,000 taxing jurisdictions, because Texas has 1,700 and Missouri has 2,000. So there's lots of places, heck, even South Dakota has 300. Lots of places have lots of local governments. What makes California's complicated is the difference between sales tax and use tax, and yet your obligation as a seller to remit sales tax, local district sales taxes where you have a location, and local district use taxes where you're engaged in business but don't have a location. Makes this return very, very complicated. And if you don't know how to do it, don't try to do it yourself on the first time. Get a professional to help you with that thing the first time. Returns are filed monthly, quarterly, semi-annually, annually. That's relatively normal around the country. It's all determined by the amount of sales that you have, and it's all determined by the Board of Equalization, and they do this when they set you up. You know, 2 years later, you can go back in and say, hey, you're making me file every month, but I'm hardly making any sales at all. Can I move to annually? And they'll let you do that. If you're big, they make you do prepayments. You can file a return on paper or electronically. One of the states that hasn't yet mandated electronic filing. They prefer it, obviously. but you can still do your return on paper if that's your preference. And then they take payments by check, ACH debit, ACH credit, and even credit cards. So remember, there's 2 tax agencies. You are very likely going to have to interact with both of them. The Franchise Tax Board for income taxes and the Board of Equalization for sales taxes. Secretary of State. Secretary of State expects to know that you're engaged in business in that state, and they'll want you to come in and register. The Employment Insurance Agency, they're going to want to know if you have employees in the state. They expect you to talk to them and to be registered and to be dealing with the employment insurance issues. And then there's you know, they have a pretty aggressive environmental agenda / program in California, and they have lots of things, lots of fees that apply to folks who impose things on the environment. And so you shouldn't be surprised if you have an obligation to see their environmental agency and be registered and be collecting or paying fees to them as well. Now, 2 common fees. I put these in here just because we have a fair number of customers that have these as an obligation. But 2 common fees on sellers are tire fees. So if you are someone who sells tires, there's a $1.75 per tire fee in California. Separate return. You know, it's not simple to administer it. And then the electronic waste recycling fee. A number of years ago, they decided that they were tired of paying the recycling for the computer monitors. And so they imposed this tax, which varies, but the fee, not tax, varies between $3 and $5, depending on the size of the computer monitor. So if you're someone who's selling computers, this is a fee the state will expect to know that, A, they want to know that you're selling monitors, and B, they're going to expect you to pay this fee to them. So there you are, folks. That's California in an hour. You could do California in a week, but I hope you found that to be useful. Whitney, do we have any questions?
Yeah, just a second. Let me pull these up for you. Let's see, the first one here. Because California is a vendor state, can back sales tax be discharged through bankruptcy?
That's a great question. Thank you very much. Most people don't pick up on this. No, you can't. As I said, in the end, a vendor state and a vendee state get to the same spot because you don't get to treat these things as debts. Yeah, nope, they don't let you write these things off. No bankruptcy. You can't get out of them, even though it's your tax that's illegally imposed upon you. It's one of the annoying things. One of the things I've always found very annoying about states who pride themselves on being on a vendee or a vendor state. It's mostly the vendor states that pride themselves on it. They said, no, wait a minute, that tax is imposed upon you, the consumer, or the seller. In the end, they treat it just like a vendee state does.
Okay, great. And let's see, another one here. If, for example, a carpet is sold and installation is part of it, is the installation considered a service contract at the time of sale?
That is my understanding. And let me make a note of that one. There is some service that's taxable. Let's see, what would be an example? If you hired, well, I'll use the example they use. If you hired someone to build you a wedding ring, you didn't buy one off the shelf, you asked them to build you a wedding ring, the labor that goes into building that wedding ring is going to be taxable, even if they separately state it, because it's part and parcel part of the cost of that ring. But if you go in and you ask them to set a diamond on a ring, you buy a ring from one jeweler and you go to another jeweler and you buy a diamond from the other jeweler and they charge you, $10,000 for the diamond, and $500 to set it on the ring. The diamond's taxable, the setting fee is not. So let me check on that carpet. If you can get their contact information, we'll get the answer back to them. I'm guessing
Yeah,
it's not.
absolutely.
I'm just guessing.
Okay. And then I know we're at time here, but there is one more prompt, and all it says is catering. So I think someone's just curious about the sales tax around catering. Do you happen to know anything about that for California?
I do not know, but we can certainly ask.
Okay, yeah, we'll make a note of it. So,
yep.
But yeah, that is it for the questions today. That's all I see.
Okay. Very good. Well, thank you everyone for joining us today. I hope this has been useful. If you have any suggestions on how we can improve it, please let us know. Thank you very much.